Howdy there, folks. Welcome in. It's a buy one, get two free in this one here today. 3 videos for me to react to, give my perspectives and opinion on. First one up here, Fed may stop raising rates, but don't expect rate cuts soon, says Wells Fargo Jay Bryson. We'll watch that one, react to that one there. Second video to react to, don't worry about what the rate is. Get your hands on capital, says Joe Terranova. Interesting. We'll react to that one and I'll kind of give my perspective. And then this last one, we think growth in tech will pull back, says BTIG. We'll hear what their perspective is. Why are tech stocks going to pull back here? What's his perspective? We know the NASDAQ's still down 4,000 plus points from highs. So I'd love to kind of hear his perspective and give my perspective as well. I appreciate every single person. Subscribe to the channel. We are now, gosh, what are we at now? 24,800 subscribers, or maybe 24,900 subscribers. I know we're getting really close to 25,000 subscribers now at this point in time, so I appreciate every single person that supports the channel. You enjoy the channel. Also, thank you everybody that supports the channel on Patreon. I appreciate y'all. We got something big coming in there in Patreon. Starting literally tomorrow, we're going to do a soft launch of it, but a new Discord chat that's going to open 30 minutes before market open, and it closes an hour after market closes every single trading day. So that's going to be pretty exciting. So if you want access to that from literally day one, then check out the pinned comment down there, and you can get access from day one to join us in there. And also tomorrow's the day I do make moves in the Patreon portfolio. So if you want access to see what stocks I'm buying, also check out pinned comment down there so you can see what moves I'm making and what I got in my portfolio for the Patreon squad right now. Alrighty, guys, let's get into this.
Start off with you, because what the markets seem to be telegraphing, at least today, is that there will be trouble ahead for the economy in terms of what we're seeing in the move in the treasury markets. There will be trouble ahead for banks, according to what we're seeing in terms of the banking sector stocks today. And there's a flight to safety going on because the tech trade is still on fire. I mean, is that the right message that we should be taking away from the Fed?
Well, I think that what the Fed is going to be doing here is, and, Jay Powell's been saying this consistently, is they're probably going to be on hold for a long period of time. They want to see inflation come back down towards their 2% target, and we're still a long way from that. So they may stop raising rates here in May, but it's not like I think they're going to be cutting rates come the third quarter.
Hold on, hold your horses, okay? First off here, the Fed, we have seen it where they can completely change their mind in 6 months. What Jerome Powell's saying about, we're not planning on cutting anytime soon, blah, blah, blah. Baloney. He doesn't know. That's the bottom line. And as we've seen with the Fed time and time again, they can change the snap of fingers. He could say, we're not cutting anytime soon. And 4 months from now, he could be cutting for all we know, right? It's so many factors. It depends on what happens in the banking system, what happens with the rate of increase in inflation, right? From what I'm looking at, we actually have real inflation right now in the 4s, right? I think CPI for the government numbers is going to start coming in probably at the 3s as soon as this summer, right? And so then we'd be at a Fed funds rate significantly above whatever inflation's coming in at, if that's the situation. So then the Fed could use any excuse on why to drop rates at that point in time. So the way I look at it is you can't put any faith into what Jerome Powell says in relation to, who knows, maybe next year we raise rates. It's very possible they could cut rates this year, okay? You shouldn't bank on that. Don't bank on that, right? But the market's already kind of telegraphing a little bit that they're expecting the Fed to actually start cutting rates in the back half of literally this year, 2023.
Steve, I'm curious, how has the expectations for pivot settled out in Fed funds futures since the meeting yesterday? And I asked you that because, he pretty much said, I don't see that in the cards this year, but I'm just wondering if markets are actually accepting that as truth.
Okay, so it depends on your definition of pivot. Is a pivot a pause or is a pivot a cut?
No,
because a cut. Okay, so if we have that Fed rate outlook chart in the back, and I'll just take a look at it while folks are looking at it at home, there is a strong expectation. There's the January 24 one. And so what is that? Wow, it's really down. It keeps falling. Powell says no cut, and markets price in more cut. That's where we're at right now. It was at 540 a couple days ago, and then it was 513 this morning, and then I just opened this up again. It's 408. So do the math. The peak funds rate, at least in the futures market, is 491. So there is, call it 90, call it 85 basis points of cut built into the market. And I can tell you when that begins. I mean, it looks like the first full quarter point cut would be built in, by August or so. So that's where we're at right now, which is sort of like, and another thing that's happened, Melissa, is the gap, which is the same thing. The Fed is at 513. The market's at 408. So you do the math right there. It's more than a full percentage point of gap between the Fed and the market. And I was just looking back at this, Melissa, when the gap changed in February. You remember we went down from it was at 75 basis points, and then it went down and the market got in sync with the Fed for the year end. You know what happened to the S&P in February? It went down 5%. So that filling of that gap, or the closing of that gap, can be painful for stocks.
Oh, definitely. And that's why I asked the question. I mean, what the market seemed to be telegraphing, Jay, is that they are expecting, unlike at least what the Fed is telegraphing at this point, something to really break. So
before we go further, let me take you back to the beginning of the fourth quarter of 2021. And what was the Fed telling us then? The Fed was basically telegraphing that Fed funds rate would exit 2022 at maybe 50 basis points to maybe 100 basis points, somewhere in there roughly, right? That's what the Fed was telegraphing. We ended the year, 400 basis points, 4% Fed funds rate, somewhere around there roughly. We're way higher right now in 2023 than the Fed ever anticipated. And so it works both ways. If the Fed says this, they say that. And honestly, Jerome Powell can't even telegraph anything around cuts right now because he doesn't want the stock market skyrocketing right now. In 6 months, in 12 months, he has no problem with that. But right now, he's doing everything in his power to try to keep this market at bay. He doesn't want the whole market to collapse, but at the same time, he doesn't want the market to go up. He wants the market to just stay, let's say, NASDAQ 10,000 to 12,000 right now. He doesn't really want to see NASDAQ under 10,000. That would be more of a significant crash rate. He doesn't really want to see it above 12. He just wants to see it range bound right now. And so he's doing everything in his power to basically do that, okay? And so if you think he can't change, I believe me, man. The Fed, Jerome Powell, all these folks, they change their minds so quick, it flips your flapjacks, okay? Let's hear more of this.
Hard that the Fed will need to cut. And that's to me what that chart tells me. And I'm wondering how you see it play out, given a banking crisis unfolding, et cetera.
So there's a little bit of disconnect, I think, between the stock market and the bond market. If the Fed's going to be cutting that much by the end of the year, I think it's because you're in real economic trouble at that point. It's not necessarily a financial crisis, right? But you are in a recession right now. And I'm not a stock market strategist, but I guess the question I would have is, are stocks priced for a recession at this point? I look at the S&P 500, it's down maybe 20% from its peak? I mean, that doesn't seem like a recession sort of thing to me. So I think there's just a little bit of disconnect to what's going on. Either that or the market thinks that the Fed is going to blink, and as the first signs of trouble, they're going to start cutting. I'm not convinced of that. I think for them, the primary culprit that they're trying to deal with here is inflation, and they want to see that come back down.
Yeah. Steve, it looks like you want to jump in.
So, yeah, it's interesting to me. I mean, the question is, how do we get there, right? I think there's some expectation in the market now that the Fed comes down to where the market is, in part because of some of the realities that we're talking about, which is credit tightening in the economy. Mm-hmm. And that's okay if that's what you think. The trouble, sort of emphasizing what Jay was saying, is I don't think a credit tightening event is going to be good for the stock market. If indeed that's how we get to lower inflation. So I think it's not crazy. And I don't know, by the way, even though Powell said he doesn't think we're cutting this year, he also said that they're going to be guided by what happens with credit markets and how that impacts the economy. So I don't think it would be a huge about face for Powell and the Fed, in fact, to cut this year if, in fact, we do have a really and serious negative fallout from the credit tightening. I'm not sure, Melissa, that we're talking about that kind of big enough event for that to happen. So far, what we've seen seems to be limited to the banks we're talking about and some of the regional banks.
So something very important we got to discuss here, okay? And I want to explain this to everybody watching this video. It's a very important point I'm about to make, okay? In how stocks are valued, how the market's valued, okay? Let's say hypothetically, the Fed cuts rates, so let's say all the way down to zero or something close to zero, let's say under 1%, okay? So if that happens, the way stocks are valued, it has to go up immensely. The higher interest rates are, the less you're willing to pay for stocks. The lower interest rates are basically the more you're willing to pay for stocks for several reasons, including the way a lot of people do DCF models, and they'll divide it out by whatever the interest rate, the Fed funds rate is at that particular time, okay? And so there's a huge difference between, let's say, a 5 number, dividing it by 5 and dividing it by 1, or 0.5 or something like that. And I mean, it's an epic difference, okay, in what you're willing to pay. Also, if you're talking about Fed funds rate all of a sudden under 1%, let's say, for instance, right? They're like, oh crap, we're in trouble, we got to cut. Then where else are you going to put money? Savings accounts will get you nothing then. CD accounts will get you nothing then. And guess what? Treasuries will get you nothing then. So then where do you have to put money? Well, shoot, then the only place to put money is maybe stocks, crypto, stuff like that, right? So these are important factors to keep in mind that I don't think a lot of people take into account, that they need to take into account. Next one up here. Don't worry what the rate is. Get your hands on capital, says Joe Terranova. Let's hear what he has to say, and then we'll react to the last one, which is around growth stocks. Tech stocks are about to go down.
The tape, as investors struggle to sort out the likely economic toll of the banking crisis, are Yellen and Powell sending mixed messages to the market? With us now, Joe Terranova, CNBC contributor and senior managing director of Virtus Investment Partners, and Alicia Levine, BNY Mellon Wealth Management, head of investment strategy and equity advisory solutions. Welcome to you both. We have to bridge the DC to Wall Street divide here a little bit, I think, and really just talk about the whole collective of what Powell did yesterday, what Powell said yesterday, what the Treasury and Congress are dealing with regard to banking stability, and then the market's attempt to handicap just exactly what kind of a drag that's going to have on the economy and earnings, Joe. What do you read into today's action with regard to all that?
Well, the market seems to be following the direction of the Russell, obviously, because of financials. We had a nice bounce this morning. Mike, I still think what I'm most bearish on is time, not so much price. I don't think people fully understand this is a correction, the magnitude of which we have not seen since the great financial crisis. And we're continuing to consolidate in this range between 3,800 and 4,200. We've only had 2 closes since the midterm election below 3,800. So I think as it relates to Treasury Secretary Yellen, I think the market expects or wants her to do something that in reality she can't do. First of all, she legally can't do it because of the requirement that Congress would have to raise the limit on FDIC. But I think that Treasury Secretary Yellen is trying to communicate that she doesn't think she needs to do it.
That's right. Yeah.
Now, the market is saying something completely different, and I think what you look at is the market always ultimately. I think the market has been right throughout this process. But lastly, let's remember something. Treasury yields, in particular, 2-year Treasury, Mike, it's down 140 basis points since 10 days ago.
New low for the year.
That's actually helping and offering some relief.
1.4% is 140 basis points for those that might not know at home. Incredible.
A lot of the long-term assets that are sitting on bank balance sheets that were so stressed 10 days ago.
That is true, although, Alicia, what it also means is the market has quickly gone to pricing in a pretty significant round of Fed rate cuts later in the year. Fed says that's not going to happen. The market thinks it's going to happen. It's going to press that bet. And it really gets to the point, which is we're now closer to when the Fed perhaps is done tightening than we thought we were going to be a couple of months ago. But at what cost in terms of what it means for the economy?
Right. And the question is, of course, why will the Fed be closer to the end than to the beginning? And is the Fed done altogether? And of course, the answer is, well, that must mean that there's a slowdown coming in the real economy driven by...
I gotta say this, man. I gotta get this off my chest because this just doesn't make any dang sense. What these Wall Streeters do many times. These Wall Streeters love to look down the road and say, "Oh, recession, blah blah blah, economy, blah blah blah, whatever." Okay, cool. But then they refuse to acknowledge the main thing that has hurt the stock market and companies in general for the past 12 to 18 months, which is inflation. And the fact is, if you look at real-time inflation numbers, they are dropping off a cliff the last several months. And so the fact is, if you want to look to the future, you got to look all the way to the future. You can't just look at unemployment. You can't just look at the economy. You can't just look at this. You can't just pick and choose. You need to look at the whole show. And that includes real-time inflation. And if you go to something like true inflation, that's going to show you kind of real-time where we're at. We're in the 4s right now. We're on our way to the 3s. And these folks on Wall Street just, are totally missing that. And why is the Fed had to raise rates so much? Because of inflation. So if that component goes away, the Fed doesn't need to keep rates here anymore. There's no need to. And they're just totally missing this. And I'm like, it's so right in front of them, but they can't see it. And they don't talk about it. And I'm like, how are you guys going to be so forward-looking on everything else, but you're not going to be forward-looking on inflation? Like that's just ridiculous to me. How to say that?
The contraction of credit from the small and medium-sized banks, which they will have to do in order to right-size their business models as of today. And the stock market's actually really interesting because it is hanging in there to that 3,800 low, really looking through what might happen in the real economy to where the Fed's going to cut. And it's taking the lead from the bond market to say, look, if the Fed is done and if there are cuts by the end of the year, we're going to stabilize, and therefore the market's going to be okay. Now, the question is this the trade after the trade, or do we have to live through something worse in between?
Right.
Right now, the stock market's telling you it's going to be all right.
Or that there's a path, right, to it being all right. I mean, look, the formula seems to be Microsoft goes up almost 2% a day, and that means that the regional bank stocks can be down 3% every day. I mean, that can only go on for so long. It seems that relationship's gotten a little stretched.
It's very stretched. It's very extreme. These kind of parabolic moves don't last for long. There's an end to them, and when they end, those relationships tend to right-size themselves. But again,
these Wall Streeters must be in the wrong stocks if they're calling Microsoft's move parabolic. Holy smokers, that ain't no joke. Certainly not call that a parabolic move. It's a decent move. It's, good for Microsoft, but I'm just like, parabolic? Oh, gosh.
Still have Treasury Secretary
Tesla 2019 through, 2021, that was parabolic. Elf stock, that was parabolic. I mean, I can show you some parabolic stocks, but yeah.
testifying on this. It's in the news, it's in front of mind, and there's rush to those stocks that are the safety trade, which have historically worked. And the question is that really where we're going here?
Yeah, Joe.
I think the market sees the disinflationary effect, and
Sure.
if there was anything that I was disappointed in yesterday, it was Chairman Powell did not really acknowledge properly the disinflationary effect. And the disinflationary effect means ultimately that when he used the word pain, he was probably correct in using that word, because that really is what is ahead for consumers. You look at commodity prices, the significant decline that you're seeing.
Consumers, I'll let him finish, okay? He's almost done here, but damn it, I'm getting pissed now.
That's signaling the disinflationary effect. You're seeing the flight to gold. Mike, you're using Microsoft as an example, but a lot of these mega caps are perceived to be as not in need of capital in an environment where we know 3 to 6 months from now, if you get your hands on capital right now, don't worry about what the rate is. Get your hands on the capital and make sure that you have the liquidity.
So, these Wall Streeters, right? I got to get this off my chest now. They're networked with, guess what, a bunch of other Wall Streeters. So they're kind of in their little own bubble, right? And a lot of times they don't get out of that networked little bubble, right? And they don't even have to get out of that bubble and speak to real people. But if they just actually looked at let's say pull up maybe the Michigan Consumer Confidence Index, right? And you will see that in mid-2022, when inflation was sky high, gas prices were sky high, consumer confidence fell to the lowest we've ever seen in the history of that survey, right? And since then, it has started to improve. And as inflation's become less of a problem, it's still a problem, but it's becoming less of a problem, guess what's happened to consumer confidence? Up, 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 up. You can pull up the chart. It's going to show you exactly how the average person's feeling out there. And they're talking about the consumer worse. It doesn't get any worse than it got in 2022. Because think about it. Even if you were to say unemployment goes to, I'll just throw a number out, 7%, which is insanely high from here. You need millions of jobs to be lost to get to 7%, right? Well, that means 93% still have jobs. And those 93% in a disinflationary environment is going to feel dramatically better than the way they felt in 2022. Dramatically better. It gets no worse for the consumer than what the consumer faced in 2022. It gets no worse for the average person than what happened in 2022, and that's a fact. It's not an opinion. The consumer tells you, okay? And so as long as inflation continues on this, let's call it downward trajectory, right, the consumer is going to be in a better and better place moving forward, and not just in the back half of 2023, but in 2024 and moving into future years, okay? So I think that's so important, and I just think it's been completely missed, because people can be hurt many different ways. Unemployment can be a problem, right? But inflation is arguably 10x worse for the average person than if you had an unemployment rate 7%, 8%, 10%, for instance. Okay? And I just think they miss that. And I'm like, geez, man, they don't understand like what really affects the middle class so negatively. It's when, all of a sudden you go to the grocery store and it costs 10%, 15%, 20% more than what you were spending previously. And you're like, what? How is it this much? When you go to the gas station in like it was last summer, right? People gassing up. What was the average? I think the average even got up to $5 a gallon last summer, right? The previous summer was what? 3 something? That's a crazy difference. People that's insane, right? So, anyways, that's just totally missed, and I think it's so important, and all that ends up affecting company numbers very negatively or positively in the entire economy. Next up here, we think growth stocks and tech stocks will pull back. BTIG says. Let's get into this one.
Good to check in with you here. The S&P 500 has traded the same 2% or so back and forth about a half dozen times in the last couple days here. How do you think this choppy range is going to resolve?
Good day for Mike, Ron.
Yeah, so it's really a perfect situation where you've had extreme dispersion below the surface. We know the banks have been kind of front and center. Then you've started to see REITs started to break down, insurance broke down today. And then on the other side of the coin, you have, large cap tech growth, semi-software, really doing quite well. And so we think it's largely a function of internal rotation. And if you're a long-only money manager with a mandate to be fully invested and you've been selling, cyclical stocks, of course that money's going to find its way into the perceived safe haven of large cap growth and tech. Ultimately, we think, we've been saying this rubber band is stretched. You can look at any number of metrics, small caps to NASDAQ, value to growth. We're pushing decade extremes in some of those ratios. And so, the question is, does it resolve by banks and small caps rallying or by tech and growth pulling back? And we think it's the latter. Typically, that's how it resolves. Breadth continues to narrow, which is what we've seen. And ultimately, the lone holdouts finally succumb to the downside. So we think we're closer to that point. And ultimately, that brings the S&P lower from here.
Yeah. I would love that. The problem is these folks keep making these predictions and they just, it keeps being wrong and wrong. But I'm hoping, there's a lot of obviously great NASDAQ stocks that are already a steal deal, but I would love them for cheaper prices as somebody that's a buyer every single week in the market, right? Give me them.
And do you think that we have to be bracing for something that goes below this lower end of the broader range? I mean, we did hold above like the December lows. We've managed to stay a little bit clear of those October trough levels so far.
Yeah, I mean, again, if you look at something like the equal weight S&P 500, that's still flirting with its December lows. So we do think for the cap weight S&P 500, ultimately the October lows are probably broken. Again, there's just continued deterioration below the surface. Also today, take a look at the airlines and railroads breaking down. Railroads are back to their October lows. Airlines pretty ugly today. So all of this deterioration suggests to us that once you finally get the internal rotation,
I'm gonna have to take a look at the railroads. I mean, there's usually some good values and divs in those railroads. That's interesting. I don't have, damn it, I'm mad at myself now. I don't have railroads on any of my watch list. What a slacker. I need to get those on ASAP, to be honest. That could be the next big opportunity.
It's done, and technology, finally gets pulls back. That's what's going to ultimately drive the S&P lower.
And then quickly, gold is catching some attention. It's been flirting with that 2,000 level. It obviously is kind of been leading the way here among asset classes, although I have to say it's failed a few times around here in the last few years, hasn't it?
Yeah, it has. And so if you've been waiting for that breakout, it's been a bit frustrating. But we think now it's kind of setting up as the perfect storm here for gold because you have a moderating dollar, and the dollar's falling as expectations of rate cuts come into play, right? So you have a falling dollar, which is bullish for gold. You have falling real rates as the economic slowdown picks up steam. So those are two pretty bullish ingredients for gold. Plus, you have some some macro uncertainty, right? So we think that's constructive. If you look at gold in other currency terms, it's already broken out to multi-year or all-time highs, and so we do expect gold to finally break out above 2,000. And if and when that finally occurs, that's when we think you're going to get finally some outperformance in stuff like the gold miners and silver, which have been lagging during this gold move.
All right, worth watching. Jonathan, thanks very much.
Yeah, so my warning around gold specifically is you got to understand, like gold, anytime there's a lot of uncertainty, banking system, banks failing, stuff like that, gold's going to always do very, very well in that. But as soon as a few weeks go by, a few months go by, and you don't really hear much about, let's call it banks going under or any financial instability, that's when gold starts to struggle. And so I think it's very important that everybody kind of understands that. And you can see that correlation actually in the great financial crisis as well. When there started to be less and less worries about the banking system and banks moving forward, that's when gold started to actually fall and stopped going up. So just something to keep in mind, an eye on from kind of that perspective. So I appreciate everybody joining me as always. Thanks for being subscribed, folks. If you want to join us in the new Discord chat from literally day one, then check out the pinned comment down there and see all the moves I'm making in the market. I appreciate y'all. Much love as always, and have a great day.